The markets are getting pretty punished today. So the question we have to ask ourselves is, in the relationship between fear and greed, how close are we to a buying juncture? We're going to explore that a little bit and take some questions today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. I don't need to tell you that the market is obviously getting well and thoroughly shellacked today. And one of the things I thought we might explore a little bit is, at what point are we due for a bounce? And what might we look to establish that? Now, you'll have to forgive me because I have to actually boot up some applications here. We had to restart some machinery just before we went live today. So I'm going to pull this up because one of my APIs has to feed the chart I'm about to show you. And it's taking a second here to boot up. But before we get to that, one of the things I figured I would share is, and I'm sure some people have observed this, that when the VIX gets to a very elevated level, we'll call it an extreme level, sometimes that has proved to be a decent juncture to get long equities. And the rationale for that, of course, is that when concern turns to anxiety, anxiety to fear, and fear to panic, what can happen is some fairly indiscriminate selling. And you'll forgive me as I'm just going through this as I try to fire some things up over here. So the question we have to ask ourselves then is, well, what constitutes panic, and how do we distinguish panic from fear or just mere concern? So what I did was, so there's a quote on the Bloomberg today from Professor Sir Andrew Wiles. And I don't know if anybody knows who that is. It's one of the more compelling stories. So his quote today, which pops up on the Bloomberg, so whenever you boot the Bloomberg up, often gives you a quote from some famous individual, and sometimes I pay attention to them, sometimes I don't. But Andrew Wiles is the professor who, it's a really compelling story and a remarkable amount of persistence. He's the one that solved Fermat's last theorem. And so if you haven't, there's a documentary about it. I encourage you to look into it. It's quite a remarkable story. Okay, so the first thing I'm going to do is I'm just going to pull up a chart of the VIX index. Okay, that's right. We just rebooted everything, so even the connections here. I apologize for this, but we did not suffer a DDoS attack the way X did today. So that's not the cause of this. Just sometimes when you have multiple applications running, you can experience some snafus, and so we did today. So I'm going to just ask the producer, are you able to see my screens? And if so, what screen do you see? So all right, good. So we are now showing what we want to show, which is a chart of the VIX index. Now, the first thing I'm going to do is just go back as far as we have data. So the VIX index wasn't actually tabulated and was not a thing back in the 1990s. But the VIX index is actually calculated off of SPX options prices. So because of that, for as long as they had decently scrubbed historical implied volatility data, and they do, going back to 1990, they were actually able to calculate it retroactively, which is what they did. So we actually have VIX data that goes back to January 2nd of 1990. And this is a chart of what that looks like. Now, many of these very severe spikes that we see in here are probably events with which many of you are familiar. So I'm just going to go in here around the 30 level, because we're not quite there yet, but we're getting close. And I'm going to point out why I think this is kind of an interesting juncture in a moment. But over here, so 1998, this corresponds with the Russian default. The Russian default set off a cascade of problems, but this coincides with the failure of the large hedge fund at the time, in numbers that now seem quaint, long-term capital management. And then, of course, we have the tech wreck in here. We have the great financial crisis in here. We had a couple other moments where we got these big spikes. Now, you'll notice in here that you'd say, well, didn't the VIX actually get well above the mid-40s? And yes, it did. That's because this is actually quarterly data. So I'm going to show in a moment that some of the the daily data actually had much higher levels. Then, of course, we had the pandemic plunge. We had the taper tantrum in late 2018, so that's over here. And then, of course, in 2022, we had the series of Fed rate hikes and the bear market that followed. And so now the question is, how does this correspond to some of those prior instances? And do we think that at some point a floor might potentially be found? So what I did was I said, all right, well, why don't we just take a look at the VIX data and break it into deciles. So in that case, every bucket will have an equal number of events in it, right? So since January of 1990, there have been nearly 9,000 trading days, sessions. And so every one of these buckets then would have just shy of 900. So let's go over here. Now I have the capability to do a little bit of filtering and manipulation for these, so I can actually just throw into this what each decile represents, and you can see what the mean returns are. And I don't know how clearly this shows, but maybe I should slide this over like that. Okay. Actually, I'll bring this chart over this way so we can get a better look at it, and I can also fool around with this table. So where we are right now is essentially in the ninth decile. And what we can see is, so we're not incorporating any other factors into this. And this is not the only way you should be looking at returns. But it's important in the following sense, which is that the mean returns in the 30 days following these sort of volatility events, when they get extreme, tend to be much higher, as we can see here. So the 10th decile is this one all the way over to the right. You get a 30-day return over the subsequent 30 days on average of about 2.5%, which, for what it's worth, is more than 3 times the mean 30-day return for the S&P in all periods over the last 35 years, which is that's delineated by this blue line right here. That blue line is 81 basis points. So that means that if you take a look at the returns for every 30-day window, beginning with January 2nd of 1990 through the present day, the mean return for all of those is 81 basis points. But if you look at circumstances where you are already in the 9th or 10th decile for the VIX, the 30-day return, the mean of the 30-day returns was much higher. Now, this should make some intuitive sense to us. Why is that? Well, when do we get extreme levels in the VIX? We get them at the bottom of the pandemic plunge. We get them at October 2008. Periods like this, when the market has already really washed out. That's when you see these sort of extreme fear readings. I actually had unusual whales up earlier because they have introduced a sentiment gauge, but since I had to reboot the machine, I unfortunately don't have that handy, but let me see if I can pull that up. I'd like to. There we go. So again, I apologize for sort of being late to the party on this today. All right. Market tide. So if we go over here, this is sort of the landing page, if you will. Where is that? I don't know if it's live at the moment, but let's see here. So I was looking at this today. They also had us at relatively extreme levels of fear. They didn't break it into... where did I will find that momentarily. I thought it was actually on the market tide screens, but I could be wrong about that. They I think break it. They basically have a gauge that goes from 0 to 100. So that's another way to think about it. But the interesting thing that we have here is that if you add some other factors in, and you can use any mix of factors you like. You could say, all right, well, I'm interested to know how over or undervalued the market was. So for example, at the bottom of the GFC in October of 2008 through March of 2009, that period when the S&P was bouncing around along the bottom, it was trading at a very low multiple to the forward earnings estimates. Of course, earnings estimates were being sharply revised lower at that time, but you get the sense of it. And one of the things that we also care about is not just what the mean return is, but how volatile the underlying market is. So, because what we're really interested in are our risk-adjusted returns. So, we demand higher rates of return if the market is exhibiting significantly greater volatility. And I actually was doing that as well, calculating what, and the way you should, one way to do this, so I'll just a quick back of the napkin way to do it, is that what some people will do is they will take the return for a period, subtract the risk-free rate for the period, and divide that by the standard deviation of the period, right? To just as a way to standardize what those are. So if we consider that, the risk-free rate is in the neighborhood, and by the way, I'm going to pull up my messaging application too in case anybody's trying to reach me because everything is shut off. So I hear the producers typing furiously, but I have no idea whether they're trying to say anything to me, and if they are, I'm not logged onto that application. Yeah, so let's see here. That's where I was, I thought, in the market tide. Yeah, that's what I thought I had. Let me just pull that back up. Again, I don't know how many of you are using unusual whales. If you are, obviously, I think it has a lot of information in there. So I'm in market tide. I'm going to just refresh this sucker. Let's see. Yeah, this is what I thought see, where are you? Huh. Yeah, I thought it was going to be. Yeah, normally, what may have happened is probably when I was in the process of rebooting my machine, I accidentally moved the window. This is where that market sentiment window would normally appear. So, and this is incidentally what it would look like, if you can see here. And you can see that we're just right on that border of, it just basically crossed into extreme fear. And what I'm saying is that the mean return for the S&P in similar circumstances in history are pretty well above average in this neighborhood. And we're getting very close now to ending up in this 9th decile, at which point, actually, the risk-adjusted rates of return start going into well above average levels. And the threshold for that level in the VIX is, and this is not the most important thing, right? So it's not like there's some magic that you say, okay, well, the VIX just hit 29, and therefore I can buy. What I'm saying is that if you take a look at all regimes, and there's a lot of 30-day windows inside of 900 instances in history, right? But what I am saying is that the risk-adjusted rates of return are now starting to get into this realm of relative attractiveness. And I was looking at this before and saw that that threshold where you basically cross into the 10th decile for the VIX is about 29. Now, obviously, as each passing day takes place, you're adding more and more data to it, but it's not going to move it that much because, like I said, there's 9,000 sessions in all of this. Adding one or two, as we, isn't going to make a huge difference. Okay, so with that, I think what we can do now is take some questions because the last couple of live streams we've done, since we had Dark Side and Mark on Friday talking about Bitcoin, which I see is the first question, and we had Brian Stutland with us last Wednesday, we were having more general conversations, and consequently we didn't get to as many questions as we normally would like to. We're going to try to make sure that in future when we have more people participating that we're able to get to that. Okay, so Alex V says, good morning, Mike. Bitcoin IBIT just broke the 200 exponent. Yeah, so this moving, this is interesting, actually. I was looking at this too today. And what was interesting, and I wasn't sure why, it looked to me there should not have been a big difference. Oops. There should not have been a big difference between when Bitcoin crossed the 200 and IBIT, which is the Bitcoin ETF did. But it did look like one crossed well in advance. And that could have been, yeah, so IBIT is just lingering according to that, but this violated. So it looks like it actually broke through in the prior session, but is now comfortably below. Whereas IBIT, I'm assuming this is just because of a limited data set or something that we're in this area. But this is the one I would probably take a look at. And yeah, so my thinking on this was that, we have had this unfilled gap in IBIT at least, and we have another here. So, 65,000, that is indeed the kind of area that this appears to be targeting at the moment. So from a technical point of view, it's not looking too wonderful here. And if we just take a look at this quick function here, which allows us to just quickly examine how many technical indicators are positive, how many are negative, we can see that the preponderance, ignore buy and hold, as I often say, I haven't shown the screen in a few times, but as you can see, there's a handful that suggest that perhaps it's oversold, but the bulk of technical indicators at this point are bearish. So, and of those that have been successful over the course of the last year, we can see again that most of them are bearish. Buy and hold, we can ignore that. In fact, all are bearish except for the K band, for what it's worth. Finwest, aloha, and good morning, Mike. Handful of earnings this week to look over. We can look at some of those earnings. I kind of feel, so here's something I didn't say at the beginning, but I think this is rather important. As we think about what the administration is trying to do here with this on-again, off-again tariff stuff, which is elevating uncertainty and I think contributing meaningfully to the volatility we're seeing, folks might ask themselves, well, why would they be doing this? What is the objective of the administration in creating an environment of uncertainty, creating an environment of volatility, and frankly, putting us into risk-off mode? And one of the things I think we ought to be thinking about is that as they try to cut items from the budget because they're trying to reduce the deficit, one of the things we need to be cognizant of is that the prior administration financed a considerable amount of the incremental debt that they took on with very short-term maturities. So Janet Yellen issued a lot of short-term debt, and then we've previously covered this, at well under 100 basis points, probably with a mean coupon in somewhere in the neighborhood of 40 bips, at a time when they could have financed at very long rates at, call it 1.6, 1.7%. And now the current administration, well, the current government, it's not just the administration, right, is faced with the very unhappy prospect of needing to roll that debt at substantially higher rates. Now, in order to get rates down, one of the things that would need to happen is you would need to see inflation expectations drop, and you would need to see growth expectations drop, both, frankly. That's the only way that you can probably get rates back down to, well, I don't know that we're ever going to get them back down to where they were, but to get them substantially lower than they are now. So is it possible that they are trying to effectively, land it on an aircraft carrier here where they can slow things down enough that they can get the long end of the curve down and refinance? Because as we had previously covered on an earlier live stream, the incremental interest expense for the debt that has to be rolled over the course of the next 18 months or so was was and is in the neighborhood of about $230 billion a year incrementally. So what do I mean by that? We're paying about $1 trillion a year in interest expense. And if you take a look at all of that short-term debt that has to be rolled at much, much higher rates, the incremental annual interest expense was over $200 billion when I looked at it. Now, look, we're actually in a slightly lower rate environment now, so those numbers have changed. I did that calculation several weeks ago. But this would help explain why we're seeing this type of behavior. Is it a good idea? I don't know, but I would just point that out. Need to be sure that the widget enabled. Okay. So I will take a look at that in just a minute, but let's just move on to another couple quick questions, and I'll get back to that fear indicator. All right. So Finwest says, I was going shopping for some stocks, ETFs for my dividend portfolio, but the charts weren't too bearish for that segment of the market. Yeah, I mean, like I say, so this is the other interesting thing. We also have dropped out of the most of the upper deciles of valuation in terms of the multiple to forward earnings estimates. So the market decline has, of course, made stocks cheaper. We were in the 9th decile for that. So if we think about the 35-year history of the S&P going back to January of 1990, the mean forward multiple was probably just under 18. Let's use 18 as a round number, 18 times forward earnings estimates. And we had gotten to a very high number. We are substantially lower than that now. In fact, actually, let's just take a quick peek and see where we are at this moment. But I did notice that I think we had drifted into now the 8th decile. Yeah, so you can see how much it's fallen. So yeah, we're now below 21 times, which is still above the mean, but nowhere near as much as it was just recently. Now, if you're looking at this and you're saying to yourself, well, wait a minute, how could it have declined so much? Just remember, that the S&P, even when you're calculating these forward multiples, is cap weighted, right? So it's not just the price declines that you see, but where you're seeing those declines when you do these kinds of calculations. But, the combination of the fact that we're getting into a very high level of fear, the fact that valuations are, while not screamingly attractive, are more attractive, we're getting closer to what I view, and even bear markets, by the way. So NASDAQ's now in a formal correction. But even if we get into a formal bear market, as a relative level of attractiveness to enter stocks, I think it's getting better. And some of you who are watching this almost certainly were probably a little bit anxious, as I have been, about putting any capital to work with the market at all-time highs, high valuations, and a lot of uncertainty. And now, as the markets chop around and move lower, I think we're getting to a place where things are looking a little bit more interesting. Okay, so CB, great to have this on a day like today. Would you rather be buying Google or a momentum ETF for a bounce? Been buying just a bit each day. So The thing about Alphabet, I actually talked about this last week when I was on Fast Money. I like Alphabet. That one's actually just flat cheap compared to what I expect it to deliver. It's in all the right places, huge cash flow, 17 times forward earnings. So that one actually is cheap. What's the problem? Well, the problem there is that I think some people, myself included, probably hadn't expected the FTC, which had been, really sort of reining in on these antitrust concerns. I had maybe expected that they wouldn't come down on them that hard, and it does not seem like the new administration is making things any easier. I would add, though, and this whole business about divesting Chrome, I've thought about this, and I'm struggling to understand how that works. By the way, I use Chrome quite heavily. I use I'm a paying subscriber to a lot of Alphabet's services. I use, a paid version of Google Drive and some other things. I pay for they have a paid version of Gemini, and actually all of the AI engines. I usually try to, buy their consumer versions just to sort of compare them one to another. So I like it, and one of the things I would say is that, if you look back at some prior companies that have been forcibly broken up, sometimes they ended up being worth more. This happened to Standard Oil. Is Alphabet Standard Oil? It's obviously a very different thing, but they did end up being worth more than the parent company was originally. So we are right now, just to draw a line on it, around 18 times forward. So let me just put that in. So this is where we are for Alphabet right now. Has it ever been cheaper? Yeah, it has been cheaper, but rarely, right? So I think this is one of those spots where, I like the company. Obviously, like everybody else, I'm a little bit concerned about these things. I think it's a very reasonable valuation. Can it get any cheaper? Well, it has in the past. And it did that even without the same level of concerns that we have now. But I do like it. I will say this, that the levered ETFs will, if we get a bounce, they're generally going to have a higher beta. Is that the best way to play it? Here's the thing. The way the levered ETFs work is that they often have to embed some optionality. And the higher volatility gets, the more expensive that optionality that they have is going to be. And so the decay accelerates. That isn't to say that it's unfairly priced, but it's something to be cognizant of. I was talking to somebody earlier today who was saying, I like to buy options on levered ETFs. And I said, well, of course you can do that, but don't think that there's a free lunch there. The options on the levered ETFs are going to be much more expensive than they would on the unlevered underlying asset. And the ETFs themselves also have increased costs associated with the increase in options premiums more generally. So just bear that in mind. You could, for example, if you were playing for a rebound, buy calls or call spreads in the Qs. And I think that would be a fine strategy. And as a function of the notional value of the underlying, so if you say buy calls in the Qs versus calls in a levered ETF that tracks the tech sector, what you're going to see is that the Q options are going to be commensurately less expensive because they don't have the same embedded leverage, and you could, in theory, buy more of them dollar for dollar notionally. I prefer to play just the straight underlying, and I would encourage you to do that too. Okay, so yeah, and I actually, ARK, I think they had Cathy. I wasn't listening so much as I was just watching headlines as they passed by. I saw a headline where she was basically saying, we think that the back half of the year is going to offer all of this promise. I don't know whether she was articulating the same theory that I possess, which is that I think they're trying to talk the back end of the curve down so that they can deal with some of these refi issues. But her case is that, we're going to have a lower regulatory environment. We're going to have a lower tax environment. We're going to have a lower rate environment all in the back half of the year, and all of those things are bullish at that time. Could be. I will also say, though, that all of the real optimists who suggest that, we're also hearing commentary, which viewers of this channel will know, consumer pressures and consumer issues. The Walmart CEO has pointed this out, that consumers are showing real signs of stress. So it is not just things like the delinquencies and the credit card balances and the savings account balances. It is consumer behavior. It's actually affecting how they spend, what they buy, how much of it they buy. To put things in perspective, one of the things they were saying is that towards the back half of the month, Walmart is saying that consumers are buying smaller packages of the same products that they usually get. So they went and they would buy 24 rolls of toilet paper. Now they're only buying 12. That's not a sign of a healthy consumer. So, I'm not trying to say that just because I think we are getting closer to a buy juncture for equities that, where we can be Pollyanna and just assume that everything this year is going to be great. I don't necessarily think that, but I do think that we're getting close to being poised for a bounce. 29-ish in the VIX usually is the threshold into that 10th decile, so something to think about. Steve Garcia says, what's the best way for a retail trader to play VIX mean reversion after a spike like today? Sell VIX call spreads, buy VIX put spreads, or buy VIX derivative product like SVIX? So let's do this. For anybody who doesn't know, who doesn't follow the VIX generally. So what Steve is alluding to here is that when you trade options on the VIX, this is a really important point. I know most of you know this already, but I really want to make sure that everybody gets this. When you trade options on the VIX, you are trading options on VIX futures, not spot VIX. What does that mean? Well, what we have here is all of the VIX futures. So spot VIX isn't a tradable instrument. It's just a calculation. You take the 30-day options in the SPX and you calculate the value of a weighted strip. And that's how you can go there. The SIBO has an excellent white paper on this calculation. Each and every day, it's always looking 30 days out. So that means that today's VIX is 1 day removed from tomorrow's, and 2 days removed from Wednesdays, and 3 days from Thursdays, and so on. Because they're always looking at a different strip of options. And because they're always looking at a different strip of options, you can't trade it. It's a little bit like saying, the example I always like to provide is that, the VIX is mean reverting, so is the weather, right? So you cannot simply say, okay, well, when it's January and it is 20 degrees outside, you can't buy a July call option on a 30-day forecast and say, well, I expect it to revert to 50 or higher, because July's weather is July's and January's weather is January's. And this is the way the VIX is. The futures, on the other hand, are indeed looking at windows of time, right? So if you're looking at a future a month out, it is basically the future for the 30-day forecast at that time. And that, of course, is tradable. Futures is a tradable instrument, and you can buy and sell options on those futures. But understand that they don't necessarily behave exactly the way spot VIX does. As I was saying, was it in the last live stream or the one before, short-dated implied volatility is more vol than long-dated implied vol is. And to illustrate this, I'm just going to quickly pull up a term structure chart of S&P volatility, because it's S&P options upon which the VIX index is based. And I'm going to look at two different windows in time. One, which is where we are now, and we'll look at one about a month ago when things were probably much more normal. So what you can see here is that the back end has moved higher. So the July implied volatility has gone from 14.4 round numbers up to 19.8. So it has risen, but these options have all rolled off. Those have expired. But the near dated options, like the March 12s, which were listed at the time, went from about 12.4 all the way up here to 33.4. So these are going to move around a lot more. When you're looking at the VIX index, you're looking at 30-day options. Those things can move around a lot. The longer dated future you're looking at, the less sensitivity to the near-term changes in implied volatility each of those futures will have. So understanding that, it's important to recognize that for anybody who's trying to bet on a VIX mean reversion, that the long-dated futures are not going to respond as quickly as spot VIX will. So we'll start with that. So I would say that for most people who are interested, and also, you don't want to end up trading options that don't have the underlying that you thought they did. So for this purpose, I would suggest that if you don't want to get too caught up in all of that, one of the things you can do is trade one of these instruments. So in here, I just want to show you this. You'll notice last summer, remember we had that big sell-off around August 5th? Of course, the VIX spiked during that time. And then as it sort of reverted, you got this little pop right back here. Went up about 87% in 10 trading sessions. Bear in mind that these instruments, like many of them, have these roll costs and embedded transaction costs. And this is not a flaw. It's neither a flaw nor a feature. It's just a byproduct of the complexity of continuously rolling an underlying package of derivatives. There's an associated cost to that. So I'm perfectly fine with the notion that someone might use this as a trading instrument. And you can see, actually, that if you get a reversion and that reversion takes place over a decent period of time, you can get a very handsome return in an instrument like this. And this is an example. So what was the return here that we saw? Yeah, so it went up. It was a three-bagger between March 15th of 2023 and July of 2024 before we had that huge spike. So, that's a fine way to do it, and it's mechanically very simple. Be sure that you read the prospectus for the associated instruments, whatever they happen to be, so you have a good understanding. I will say that the other thing is that you could, for example, say, well, how about if I sell strangles on the S&P, like SPX strangles? Well, that's a fine way to get short premium. But understand that if you do this, you may be taking on some delta risk as well, when your intention is to be short vol. So then you start incorporating the complexity, if it is complex for you. I don't know if it is or isn't, but it does incorporate delta hedging as another component. So if that's not something you want to engage in, if you want something that's more set and forget, then some of these instruments do have the benefit of doing exactly that. You buy them, and then if you don't turn your machines on for a week and volatility does as you expect, you will profit. Okay, so Delta just cut Q1 guidance. Thank you for pointing out that headline. I hadn't seen it. That is yet another indicator. I think I pointed out last week that I had heard some anecdotes saying that foot traffic and spend in places like Las Vegas were down a little bit. So, for some of the big carriers, a portion of it's going to be, just vacation type travel and things like that. Another portion of it is going to be business related travel. I don't know whether the business travel was one of the things that they cited as they were bringing down their forecasts. But I will say that, when you combine a lot of the things we're seeing, it was interesting. I saw, I think, was it Goldman Sachs or somebody else had brought their year-end probability of a recession up to something in the mid-30s. And, it's interesting. We've had negative economic revisions. We have a stretched consumer. The consumer's 70% of the economy. And then you've got, whether you agree with it or you don't agree with it, this sort of whipsaw tariff policy and concern, it breeds uncertainty. And you know, it's a narrow path that we go down to have an economy that is in the Goldilocks phase, where we're getting good growth, but not excessive inflation. Now, you're trying to navigate that path and correct real fiscal imbalances, and you're trying to correct trade imbalances. You know, this is and we haven't had a meaningful recession since the pandemic, really. So, and that's largely been supported by tremendous amounts of fiscal stimulus. You run a $2 trillion deficit. That's not the most efficient way to contribute to an economy, but it does contribute. Efficiently or not, you can't ignore that. You start pulling that spending out. Whether or not you think that an allocation to a nonprofit was appropriate or not, that money finds its way into the economy. Whether or not you think that the amount that the government is spending on various services, whether it is an overpriced subscription service or whether it is overpriced contracts for military stuff, that money does find its way back into the economy. You pull it back, it will have a consequence. Now, you might need to do it, but we can't. I think it's a little bit foolish to imagine that you can make all of these changes and that there won't be any pain as a result of them in the short term. I think that there will be. And so I was rather surprised to see that they had only elevated their recessionary concerns to 1 in 3 at that stage, after we had already had on-again, off-again tariffs for a couple of weeks going into that. So that was a little bit surprising to me. Okay, worth to take a look at the return distribution graphs within that bucket. Yes, that is an excellent point. And not only do I agree with it, but where did I put it? I had that. So let me see. Let's take a look. This is absolutely 100% the way you should be thinking about this. 100%. So for anybody, did I post that up? Yeah, okay. So let's take a look at what Alex is asking about. So what Alex is saying is we want to get some sense of what the return distribution looks like in these circumstances. Now, I'm going to just change this formatting so we get a couple more buckets. And again, I apologize if I hadn't had a sort of a system crash in the midst of all of this. Just before we got started, I had some of these things up. And we need a lot more buckets because this has obviously got some... So you're going to have, you know, real crash information in there, but let's get a lot more buckets in here, actually. Okay. So what the point is okay, when you're in a circumstance like this, we're not just interested in the mean. We are also very interested in, you know, the outlier events, because it should come as very little surprise that this bottom, just, you know, this very low first decile for the VIX, which has 72 basis point mean return, has a very low standard deviation. And on top of that, we didn't experience a lot of the, you know, big crashes in that kind of an environment. And of course we didn't, because generally those are precipitated by something like a credit event, Russian default, or in the GFC, suddenly a big rash or increase in the delinquencies on liars loans, that sort of thing. So you don't get those huge drawdowns in those circumstances. So what you may find is the way to identify the best regime to invest in is not by saying what's the best mean return. It's by saying what's the best return relative to risk. And that's why I'm saying this particular bucket is getting more attractive in terms of the mean return. This particular bucket actually, you know, once you get into that 10th decile, you actually do get better risk-adjusted rates of return. And that also probably shouldn't be all that surprising, because what's happening is that if you're in a rising volatility environment, you know, you're going from a complacent to concern to anxiety to fear to panic. And as that happens, that's when those real washouts occur. The amount of downside damage is going to be limited if the crash has already taken place. If you have a pandemic plunge and the market's down 30% in the course of just a couple of sessions, the chances of another 30-day plunge thereafter are actually muted. That's not what history gives us. So this is a really important point. And what we're looking at here is a distribution for these returns in this set of circumstances. But now I'm going to actually take this diagram and we are going to move this into, let's say, the 10th decile. And you get something that looks like that. So that's the 10th decile. And let's similarly say, okay, so this is all PE period. So this is going to be more representative of that 29 and higher level in the VIX, is a distribution that looks like this. Does it still have some big downside moves? It does. But, this is a much more normal looking distribution. And, remember what kinds of things these periods incorporate, right? I don't know specifically which one this one is. That could be a pandemic plunge number. That could be something from the GFC or something similar. These are all compiled off of daily returns. And to be honest, while I sometimes like to decipher and, look in and say, okay, well, what does fall into this bucket and what doesn't? The truth is I like to look at the data first and then take a look at the respective periods and be more agnostic to their cause, right? So, for example, do I just say, I'm going to ignore the pandemic plunge because we're not in one? Well, I could do that and say, that was a very different time. Or I could look at the GFC and say that was a very different time. So I don't want to incorporate that in the data. But I actually feel like there is always something new, always something surprising, and the punishment that can be exacted on equity holders may rhyme with other periods that had similar price action, even if the cause was not the same. And so I think sometimes it's also healthy not to try to dice, slice and dice it too much. The other thing I would say is that if your sample size gets too small, it's not meaningful. If you start saying, well, what if the PE was above 25 and the VIX was rising and it was in the 10th decile and it was a Thursday, you could get some very funky looking data or interesting looking data, but that's not necessarily meaningful. So you have to be very careful about that. And I try to be, I want to slice it up enough that I have some context, but not so much that I have a sample size that's really lacking utility. Okay, so karma for everyone sharing the seasonality chart over the weekend. Were a lot of people doing that? They may have been. Okay, so let's see here. Market tide was good today. I did not enter a single long. Like I say, I just think we're getting close. Dennis Chiavi says, perhaps abusing the status of reserve currency of the world. I think we've been abusing that for a while, to be honest. A $2 trillion deficit on a $29 trillion economy is 7% of GDP-ish. It's really outrageous. We can't do that forever. And it needs to be corrected. And the problem is that there is no way to correct it that doesn't exact some pain, even if it needs to be done. And that's, I think, really the hard part is that, I've heard people describe the economy in various different ways, often involving a sick patient, being pumped full of morphine. We have modern monetary theorists who try to drink themselves sober, print money and just have whatever we want and think that there's no consequence and that it all turns out fine in the end. That's not the case. They tend to happily ignore a lot of the secular tailwinds that helped them out along the way. So we had secular tailwinds that were deflationary in the form of, globalization, increasing our imports from China, productivity improvements, hosts of things like this. And, for a long time, politicians were more than happy to try to take advantage of deflationary impacts and essentially create enough inflation and use that for their own purposes. You get into a situation like we have now, and it's a real problem. Now, if we also got into a deflationary situation in isolation, we're not necessarily going to do that because secular tailwinds have turned to headwinds. But if you did, you could create a real problem. But trying to negotiate our way out of this problem cannot be done pain-free. In the drinking analogy, there will be a hangover. And if the patient is so sick that they either need the morphine to quell the pain or they need IV fluids to stay alive, reducing the amount of those is either going to increase the pain or it's going to have some other impact. That's just the sad reality. AP says the Delta CEO just said, I don't think a recession is coming. Well, that's... I hope he's right. Like, none of us want that. I want to make... One of the things I've found is that, and I've seen, I got into the markets out of doing, which I think I previously described, some audit work on government contracts for nonprofit agencies, as it happens. So I have a little bit of experience with a lot of the things that are going on now. But, I went down to the Philadelphia Stock Exchange in the mid-late 90s. And since that time, I've seen several material pullbacks. And while I will tell you that there was always a handful of traders who either because they were bearish or because they owned a lot of gamma or vol or something ended up making a lot of money when the market swooned, prolonged downturns are generally not good for anybody. Bulls or bears alike. We don't want to root for that. We obviously want some healthiness. Tucker D. Dog, some consumers are buying smaller quantities as packaging shrinks to hide inflation, and that 1 pound of bacon is not 12 ounces. I've been wondering about that. Are they adding water to these things? It's not just that the package is getting smaller, but I sometimes feel like there's water being added to the packaging. That could just be my, it could be perception. I may be wrong, but it sure as hell seems like it. Good analogy with the weather there. That helped. Okay, I'm glad. Hit the thumbs up. Keep Mike with us, Finn West says. Yes, I appreciate that. Thumbs up, like, subscribe, all those kinds of good things. We definitely... I want to actually get... so it's not just me talking to you guys. Hopefully Brian Stutland will be joining us again on Wednesday. I have reached out to other friends and former colleagues, some of whom you may know from CNBC, and others who you most certainly don't. One of the people that I've reached out to is my former boss from Ivory. Very, very good investor. And, he has some interesting and unique insights. And he's a deep dive fundamental guy, does a lot of pairs trading, so long, short, straight equity types of trading. Not a whole lot of option stuff, at least not that I'm aware of. But, he has a real background in real estate investing and high yield also, which I think is an exceptional foundation for equity investing. AP says, get a scale and test the food weight minus water. So that's the interesting thing. I've cooked things and I just see massive amounts of steam coming off of things. And I think, God, it just does. There's liquid pouring out, whether it's bacon, which I don't get to buy that often because my wife doesn't want me eating bacon. But it does seem like it's a bit fishy, for what it's worth. So anyway, let's see what else we got here. Have any more questions? So yeah, if you have any more questions, be sure to throw them in. Let me just quickly, what I'm going to do for this distribution right now is just, so VIX 10th decile, PE, that's a good question. Where are we right now on the PE in terms of percentiles? So what did I say? It was around 21. So 21, 20-ish. Yeah, that's the 8th PE decile. So that's going to look a little bit like that. Take a look at that. Right? So it's obviously a more limited data set, but one of the things you found is that whatever that did, it just clipped off that extraordinary tail move to the left. Again, this is not a clean prediction, and you don't want to filter these things too much because the data becomes meaningless. There's only 100 data points in this subset, for example, and out of 9,000, that's filtering things pretty narrowly. I'm being asked, did I skip the question on gold futures? No. Did I miss a gold futures question? Where is it? Anil. What do you think about gold futures spreads as a hedge in this uncertainty, and where do you see gold if Trump gets success with Ukraine-Russia ceasefire? Someone from Florida trying to reach out to me. They are going straight to voicemail. So I am, as I think many of you will know from my acronym, rising at the beginning of the year with the one with 2 G's, which had Google in it, which is obviously very punishing, but G was for gold also. So I am generally bullish in terms of gold, although don't forget, that correlations 10 to 1 when you get into a risk-off environment. I do feel like gold's probably a little bit safer. If we get some really low inflation prints, that's not as bullish for gold. If rates come down, though, that reduces the carry. And so that could potentially be better for gold. It's still, in my view, comfortably in its uptrend. So I think we kind of stick with it. Yeah, so I haven't changed my position on this. I still think that an allocation to gold remains appropriate. I'm not 100% sure how much impact Ukraine-Russia ceasefire would necessarily have. What I do know, and the thing that I would actually pay more attention to than just that one thing, is that the movement and delivery on the physical. So the fact that a lot of people are taking physical delivery, the fact that people are moving physical gold around the world, to me, that all speaks to demand. Now, in gold's case, unlike some other commodities, you won't typically see the curve get out of whack. So, when one of the things that you are a bullish sign for many commodities is when you get the curve into backwardation. Backwardation suggests that there is excess near-term demand, and that's bullish. Gold doesn't typically have that problem because it's not a perishable commodity. There's a lot of it in storage, but the same thing still applies, which is if demand for the physical is high, I consider that bullish. So as long as that remains true, I would remain bullish for gold. I hope that helps, and I hope everybody knows what I mean by that. So again, it's the same thing. A lot of commodities which are very perishable or instantaneous, like electricity. Not easy to store electricity, and so you have real volatility in the short term. Natural gas is not quite the same. You can store natural gas and you can ship natural gas, but it's not as easy as it is to do with oil, for example. And, you have perishable commodities too. Gold is, doesn't deteriorate, so it's non-perishable. But the fact is that if there's more demand than usual for the physical, that's bullish in my view. So I hope that helps. Bot lift. Michael Anthony says bot lift at 1150. Balance sheet looks great. So yeah, this is kind of an interesting thing, right? So one of the things we're going to find is that some previous high flying stocks are now getting down to some really interesting multiples. These were companies that were not profitable all that long ago and traded at much higher multiples. So, for example, look at 2021. Lyft lost $1.1 billion in 2021, and the business was valued at $14.7. Now the company has $800 million in net cash. It has positive free cash flow, And the full year estimated earnings is 91 cents a share. So, now you're dealing with, the margin of safety on some of these things has totally changed. The thing is trading 12.6 times full year estimated earnings. It's trading 9 times estimated earnings for next year. Let's just round it out and call it $700 million of free cash flow over a $4 billion enterprise value. Why not? That's 17% free cash flow yield. Yeah, so I like that trade. Yes, the balance sheet does look good. It is, and this is one other thing, is that, we have so much passive investing now. So, and passive investing is twofold. Passive investing comes in the form of people just automatically withdraw from their paychecks and it goes into their 401k and gets put into whatever one of the little radio button selections that they made, or they just simply buy SPY, or they buy RSP or the Qs or the diamonds or whatever. That's all passive investing. And then there's another branch of it too. We have a whole group of people that do things like closet indexing, because I've run a mutual fund, right? And I did not pick stocks based on where they were in the S&P, but you sure felt it when you didn't, because if for whatever reason one of those, there were big money flows into the market, those stocks got lifted, and if you didn't own them, now you're lagging. So there's a lot of closet indexing that goes on, and this passive investing phenomena is going to have an impact in both directions. It can propel stocks to levels where they shouldn't be on the upside, and it should push them down to levels that they shouldn't be on the downside too. And that's something to be well aware of and keep an eye out on. So, Eric, hi. Bought 2 times short Tesla. It's up 30% in a few days. What's your thought about Tesla from here? So this is interesting. For those of you who have, followed me at all for any decent amount of time, you probably know I have something called the Holly Index. Holly Index is sort of my barometer for what consumer preferences are, because I'm not a shopper and I don't really buy a whole lot of stuff. I end up buying a lot of stuff, but I'm not the one making a determination about what those things are. And Tesla has been on the list. The problem with Tesla for me is that I've just had a very hard time getting around the valuation. There's a lot of pressure on the stock simply because it was a very high valuation, but there's additional pressure now because Elon Musk's government involvement is not viewed favorably in all quarters. In fact, I think we can safely say that there are distinct groups of the population that are very unhappy about it. Some of those people are going to be unhappy about it because the things he's doing impact them directly in an adverse way, and in some cases they might deserve it. Other cases, maybe not. But the fact is, we are seeing a lot of organized activity targeting Teslas. My wife drives a Tesla. At one point we had 2 of them. I do not drive one. But I will tell you that I recently went out to dinner and I ended up parking behind a Tesla that was in front of us. And there was a bumper sticker on the back of it that said, I bought this car before I knew he was a nut, or something like that. People are putting bumper stickers on the backs of their cars saying, don't destroy my car because it's a Tesla. Well, and I knew somebody else who came back to their car and somebody had slapped a sticker on it that suggested he was, I don't even know what happens to you if you start saying certain words on YouTube, so I'll probably try to avoid it. But let's just say that he was attributed with a fascist party from World War II. And that was slapped on the back of this person's car. Person's like a local teacher, humanities teacher. But this kind of thing is not healthy, right? It's not healthy for Tesla. And it's going to weigh on it for a while. So I was looking at the stock, and I was thinking, could it actually go back to, was it last April's prices? When I was looking at this earlier today, I saw an unfilled gap over there, and that's over here, 150-ish. I realize that seems quite incredible. Something else to think about, when in Trump's first term, he lost a huge amount of his net worth in his first term between when he came into office and the lows thereafter. He recovered somewhat. But I made the point that it was something like 40% of his net worth. So it was very costly to Trump his first term. And I actually half-jokingly said something to somebody about Elon Musk. Is it possible that he could have a similar pullback? Well, as it happens, we're basically right back to where Tesla was pre-election, right? So let's put that in. We'll just draw a line. There's the pre-election number. We're right there. What's a 40% drawdown? And this is totally arbitrary, right? I'm not saying that, because it's got to have a 40% drawdown. That's going to get us down to, oops, that's not what I wanted. Sorry. So that's $133. So a bit lower. These are arbitrary levels as I draw them, right? Because what's an appropriate valuation? I mean, Tesla doesn't have that many comps. It's going to trade up on enthusiasm for things that they're doing in the AI space. It's going to trade up on enthusiasm for things that they're doing in the full self-driving space. And it traded up on enthusiasm for Elon's association with the administration. I think the bloom is off of that rose completely. And people no longer view his association with the administration as a positive for the company. Any government contracts with Tesla are going to be, they're going to look over those with a fine-tooth comb. So don't expect that there's a favorable relationship that could result in anything. And even so, it wouldn't matter. To put things in perspective, they were talking about State Department buying armored vehicles, and then everyone made a huge fuss because they thought there was a $400 million carve-out for Tesla. Some of those allocations had supposedly been made before by the Biden administration, but it doesn't really matter. They made a huge fuss over $400 million. $400 million in the grand scheme of things for Tesla is not meaningful. But it was meaningful in the sense of the amount of scrutiny that it got. So that just means that they're going to have to do twice as much, twice as hard. It's going to be very difficult. It's a difficult environment. It's very hard to work closely with government when you are also in business and not have the periodic appearance of conflicts of interest if there are any government contracts. So I wouldn't expect any benefits. And it's a PR nightmare, best I can tell. So, love the company, love their products, love the fact that they're the only ones other than BYD that seem to be able to sell an electric vehicle at a meaningful profit margin. I like their business model. I love their full self-driving technology, but I don't love the valuation. And I just think, it's a very, very, I was talking about that path before, how you're trying to manage growth and bring down the deficit and all those other things. I think Elon, irrespective of all of the economic concerns, he too has a very, very narrow path that he can follow, where he's not going to start essentially repelling some critical consumers of his products. And who do you think's buying EVs? Who are the early adopters of EVs? It wasn't the guy who was buying a Power Stroke F-350. These are so he's kind of alienating a core piece, people that live in and around where we are, Marin County, California. Every other car seems like it's a Tesla. But I don't know that they're hurrying out to buy them now. And, that's a problem. So I think there is potentially more downside. That gap has been filled, though. That actually is kind of a positive. So we did actually, this was the one I was looking at earlier today, and today we filled it. So this was the first one, that got filled, and then today, on a $40 drop, we filled that one. So the only one left, let's draw one more line in here. Let's see if we can. So to me, where does that get us? Not there. Yeah, that's a long way down. And like I said, we're getting close to that 10th decile. Finwest says Teslas are everywhere in Honolulu. Yeah, I get it, But are they flying off the lot as quickly now as they did 18 months ago? Probably not, I would bet. Though the new Model Y looks really good. I was invited to go check one out. I haven't yet. But I think Tesla, like all the high beta stocks, is likely to get a bid when the market, even if we get into it's a bear market rally, we're getting there, right? VIX at 30, I kind of feel like you probably have to buy it for a bounce. And we're awfully close. In fact, actually, the 10th decile, that pillar that I was showing, that bucket, technically starts at 29, not even 30. So we actually got there today, for what it's worth. And Finwest says, I do... what was the other question? Sorry. Okay. I am looking for that. Is there multiple pages in here? Did I miss? I missed a question. I'm being reminded. I'm going to take one more, and then we'll hopefully get some more. Bunny 23. Here we are. And now I lost it again. There we are. Oh, thanks for teaching us. How do you usually come off from a strangle swap after the earnings report, especially the losing legs? So I usually correct those things straight away, right? The strangle swap trades, I don't fiddle around with those. I usually close because here's the important thing, right? So the weak side of the long leg, especially if it's an upside, right after the event, sometimes the vol doesn't get clipped too much, but the short option on the losing side, if you're moving away from... Okay, so let me just clarify for everybody. Doesn't really imagine. Stock XYZ. And now stock actually XYZ that's block payments now, so it is a real ticker, but we still use it as a generic. So let's say you have a stock that's trading 100, and you do a strangle swap up 10, down 10. So 110 strike, 90 strike, okay? And I'm long. So I'm long, let's call it a 5-month, 6-month strangle, and I'm short, say, a 45-day strangle inbound, going into an event, playing off the vol crush that's going to happen on the near side. So the stock, earnings come out, and the stock runs. It runs up to 110. Well, I'm going to have made money on the short 110 strike 45-day put, but I will have lost more money on the long 6-month 90 strike put. And I usually find that the thing I want to do is close that leg straight away. So those 90s, both the long and the short side, well, oftentimes the 90s, I mean, you can buy that thing back for nothing, essentially, after you get a move like that. That short put's basically zero in that case. But I will sell the 90 strike long-dated put as well. I don't want to have, these loose positions just hanging around out there. And oftentimes, in that case, vol can also start to bleed out of the longer leg over the ensuing days. So you'll probably observe this too, that right after that move, there's still some vol in the long end, and it's propped up a little bit, especially if it's a downside put like that. So it's become a tail option. And then you wait, and 3 days later, you say to yourself, well, what the heck happened? And, vol has come in, call it another 10%. So I usually try to close those out. And oftentimes what I will do is I will then readjust those strikes if I want it to be long, that option, and then sell more stuff against it. So I might just adjust the strikes up to, now there's a lower volatility environment, but, maybe it's up 7, down 7% on the long end, and then sell some near dated, call it 20 delta strangles against it. Hope that helps. But yeah, on the losing side in particular, because there's nothing worse than on the losing side, looking at it and just watching the thing become worse and worse each day. That side didn't happen. And by the way, if it goes up that 10%, I mean, the trade was a win. Put the losing side to bed, unless your thesis is very, very different. Okay, so we are now an hour and 15 minutes in, and I will try to hopefully get Brian or somebody else to join us on Wednesday. And I hope you'll join us too at 4:15 Eastern Time. Well, we will take some more questions, and maybe you won't just have to hear me talk if I do things right and get somebody else in here. Thank you very much for watching.